Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 118, titled Adjusting Our Portfolio Mix to Achieve Diversification and Cash Allocation. We're going to be using a real-life example with an analysis of the Dow 30 stocks. Now, when we set up our portfolios for option selling, or really for anything else, we want to be certain that if one particular security turns against us, that the others will be able to pick up the slack. So we don't want to be too heavily weighted in any one particular security. So let's set up some guidelines now for our portfolio positions. We don't want any one stock or industry, for that matter, to be overrepresented in our portfolios. The more positions we have, the better, as long as we're able to manage those positions. And that will vary from investor to investor. For me, I would like to have maybe between 20 and 30 positions. That's manageable for me. As far as contracts are concerned, I normally have between 75 and 100 contracts each month. So whether that's manageable for other investors, for some can manage more than I can manage, others less. So it varies from investor to investor. So we have to be comfortable with that. Now, also, in addition to not having any one stock or industry overrepresented, we also don't want to have the amount of cash allocated to any one position to be overweighted. Now, this guideline can only be approximated. We'll never be precise in terms of the cash allocation, but we certainly can set up a framework such that no one position regarding the total cash allocated to it is dramatically overweighted. So those are the guidelines that will set up the framework for this particular podcast. Now, let me talk to you for a moment about our BCI Blue Chip report, which directly relates to the Dow 30 stocks. And this is a report that we provide to our premium members once a month, and it's formulated the week of expiration of the monthly expirations. So for those of us that trade monthly options, we'll have this report in time for the beginning of the next monthly contract, which is after the third Friday of the calendar month. Now, each month we do an analysis of the Dow 30 stocks based on the price performance in both 1 and 3 month timeframes. And the Dow 30 stocks that have outperformed the S&P 500 in both of those timeframes will be listed as eligible securities for option trades. Now, there are many other factors included in these reports. Let me just list those other factors. We list the recent price of the stock when the report was fabricated. We list the earnings report date because we always avoid earnings reports. In addition to that, dividend information, the annualized yield, as well as the ex-dividend date, the date that we must own the stocks to be eligible to generate that particular dividend. We also indicate implied volatility, so we know how much risk is involved with that particular security, as well as the sector or industry that that stock is in, so we don't become too heavily overweighted in one particular sector or industry. Now, for those of you watching this podcast, a screenshot now is on your screen for the September 2020 contracts. For those of you just listening, I will describe it to you. Now, the red arrows on the top show the 1 month and 3 month price performance of the S&P 500 in the yellow cells, and then those Dow 30 stocks that have outperformed the S&P 500 in both of those time frames. So as an example, in the last 1 month at the time the report was fabricated, the S&P was up 6.74% the past month. Apple Computer, the best performing in that 1 month time frame, was up 33.92%. In the last 3 months, the S&P was up 16.25%. Apple was up 56.71%. Now, all of the securities, and there were 7 of them that outperformed the S&P in both of those time frames, outperformed, as I said, in both those time frames. Now, we sort these based on the 1 month price performance. So Apple, which was the best performing in the past month, was up 33.92%, as I said, and down to Procter & Gamble, PG, which was up 7.9%. Remember, the S&P was up 6.74%. So those are the 7 securities that we could consider as eligible for the next monthly contract, and that can also be used for weeklies as well. So how would we then structure our strategy requirements if we had a hypothetical portfolio of $250,000? Now, obviously, that's a lot of money, so it could be tweaked both lower and higher. Now, we can diversify with 7 elite performing Dow 30 stocks. So how do we allocate the cash? Well, if we had a portfolio cash of 250, that would, if you divide 7 into 250, come to approximately 36,000 per position. Here's what we do. We divide the price per share into 36,000 and round off to the nearest 100. Folks, this is a starting point. Will adjustments be necessary? Sometimes yes, and sometimes no. In this podcast, the answer is yes, and I'll tell you what we did. You also must compensate for the fact that we may need cash to execute potential exit strategy opportunities. How much cash? About 2 to 4% of our portfolio net worth. So that's how we start to structure. So let's do that and get our initial setup. So if we divided the price of per share into 36,000, in Apple's case, it would be 494.70. That comes out to 73 shares. We round up to the nearest 100. So we have 100 shares of Apple. Now, if we move to Salesforce, CRM was 216.80 per share and divided into 36,000, that would come to 166 shares, and that would round up to 200 shares. Now, an example of rounding down, Honeywell was 164.10, and that divided into 36,000 came to 219. We round down to 200, and so on. Now, when the smoke cleared, and we did that particular formula, it came out to where we'd be spending $265,724. So that's more money than we had. We only had 250,000. So we'd have to make an adjustment. Where can we make that adjustment? Well, what I chose to do with Salesforce, instead of rounding up the 166 to 200, I rounded it down to 100. Now let's do that exercise again. And what it came to was we'd be spending $244,044, and that actually was a reasonable, although not perfect, cash allocation. That also left us a cash reserve of $5,956 for potential exit strategy opportunities. Now, what comes next? Well, we access the option chains for our strike selections, and we base that on our initial time value return goal range, on our personal risk tolerance, and our overall market assessment. Once we do that and we enter our trades, we then immediately enter our 20% buy to close limit orders in case share price declines. So we're kind of partially automating our exit strategies against share price decline. Let's summarize. Portfolio risk will be mitigated by diversifying the securities in our portfolio and allocating a similar amount of cash per position. Remember, it will never be perfect, but we want to have a framework so that we want to minimize having too much cash in any one position. We must also factor in the need for a cash balance to execute potential exit strategy opportunities. 2 to 4% would be a guideline. Now, once our positions are entered, we then move to management mode, and we start by entering our 20%, 10% buy to close limit orders. Folks, before we leave, let me just mention our BCI package, which is an acronym for our best and most comprehensive investment package ever offered by the blue collar investor. It contains everything you need to master the strategies of covered call writing, selling cash secured puts, and those strategies related to those major low risk option selling strategies. It includes 6 online video courses with their downloadable workbooks, 6 calculators developed by the blue collar investor and therefore found nowhere else, 5 of our best selling books in ebook format, and our annualized premium membership, which is 13 months of membership, which includes 4 reports, including the blue chip report you saw in this particular podcast, along with our weekly stock and ETF reports and our quarterly dividend reports. So they're all included, and the membership as well includes our vast library of online training videos, approximately 200 at the time I made this podcast. We had one every single month, some months 2. And that training includes our Ask Alan video library, our Blue Hour detailed webinar series, and as I said, count on 1 or more new training videos each month. And that's only for our premium members. How to find out more about this BCI package, go to our website, www.thebluecollarinvestor.com. Click on the link at the top that says BCI package. There's written and video information on the package. Ladies and gentlemen, I want to thank you very, very much for taking the time to listen to and or watch this BCI podcast number 118, adjusting our portfolio mix to achieve diversification and cash allocation. Folks, I hope you enjoyed this presentation, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.